Today's webinar is about our 2025 economic outlook. Give me just a moment to share my screen with you because I prepared a presentation. And here it is. This year, particularly the last month, has been quite interesting, and there have been some curveballs. And so this is a perfect time to be giving everyone an update on what's going on with the economy and what we expect going forward. There's still a lot of uncertainty in the market, but things are looking a little better than they did about a month ago. Today, I'm just going to start with a quick introduction of our firm, although most, if not all of you, should know who I am and who we are because I talk to you guys pretty frequently. We'll do the market update. I'm going to focus specifically on tariffs and the effect on the economy and our relations with other countries this time. And then we'll talk about some of our current investment strategies that we're implementing. And I wanted to share some data on market corrections and pullbacks because earlier this month, or I guess last month now, it's May 1st, we had a pretty big pullback on the announcement of these tariffs, and I wanted to share with everybody some information that make them feel more comfortable about staying invested and staying the course, even when things seem uncertain and it feels like there's too much uncertainty to stay invested. We'll do a short question and answer session at the end. I'd like to ask you to keep the questions very general. If you have specific questions about your situation, please reach out to me or Josh, and we can talk to you about them privately. But this would be questions about the economy, markets in general. And we'll take a few questions at the end. Any questions we don't get to, we will reach out to you as well and answer those directly. And this is just a disclaimer. We're registered with the SEC. Everything in here is generalized and it's for informational purposes only. It is not a recommendation for your unique situation. If you want recommendations, like I just said, we can talk to you one-on-one because it'll be different for everybody. We're using information that is accurate as of now, but these things have been changing on a dime, and so things could change tomorrow. So keep that in mind as well. A little bit about our firm, Sovereign Investments. We're a registered investment advisor. We are a fiduciary, and we provide investment management, estate planning, and financial planning for our clients. We work with individuals and families like you guys. We also manage money for some retirement plans, and we manage money for other financial advisors as a third-party asset manager. And in fact, managing money, asset management is a huge part of what we do. That really separates us from a lot of other firms. And that's really what we're going to be focusing on today is the investment management piece. I'm one of the portfolio managers here. I've been here for 10 years, although I've been working for my dad, at least stuffing envelopes for mailing things to clients since I was probably 5. And I'm an attorney as well. I do a lot of estate planning for our clients. I'd like to start by just highlighting the total returns on some of the more popular indexes people like to follow so far in 2025. It's not as bad as it feels. The S&P is down 5.1% as of yesterday. Now, the S&P and the NASDAQ are up today, but as of yesterday, everything was down 5.1%. The NASDAQ was down 9.5% year to date. ACWA, which is the All-Country World Index, excluding the U.S., was actually up 8.2%. The aggregate bond was up 2.1%. Gold was up 23.8%. And Bitcoin was down 3.1%. Bitcoin is not an asset class that we invest in for our clients, but it is becoming increasingly more recognized as an asset class and is probably going to eventually be a component of most investment portfolios in the future. Although there's a lot of volatility and uncertainty in Bitcoin, it's still not appropriate for most investors. And just to kind of put this in context, the day after the president announced the Liberation Day tariffs, the S&P dropped to down about 15.5%, and the NASDAQ was down over 21%. And so there has been a huge upswing in the market in the second half of the month of April since that happened, and we've already seen a bit of a recovery. So the uncertainty is already improving. What does that mean for you? If you're invested in our long-term growth portfolio, you're probably down as of yesterday. Today, you know, your portfolio's up, but as of yesterday, you were down about 4% net of our fee year to date, so less than the S&P. That's a globally diversified portfolio, so there's some international and emerging markets in that portfolio as well. But it's more heavily domestically focused. We've invested more into international companies recently, so they're a bigger portion of that portfolio. And then we have the other growth portfolios that are stair-stepped with fixed income or bonds. If you don't know what fixed income is, that's that aggregate bond index there. Now we've picked fixed income securities based on what we expect to do well in the conditions, but those portfolios, moderate growth has about 10% fixed income. It's down about 3% year-to-date net as of yesterday. Conservative growth was down 2.8% net as of yesterday, so that's about 25% bonds. And moderate growth in income, which is 45% bonds, was down 1.4% net yesterday. Now, if you're in current equity income, that's actually an all domestic equity portfolio that has a 3.5% to 4.5% dividend yield all the time. And you'll be pleased to hear that you are not down like all of the other domestic stocks. Your portfolio is down 0.7%. These stocks are exactly the types of stocks that do well in uncertainty in these types of conditions, high quality dividend paying stocks. So I pulled this chart from Yahoo just to kind of highlight where we are, where we started on the Liberation Day tariffs. And you can see here in the chart that the entirety of North America is grayed out. That's because none of these tariffs actually applied to Canada or Mexico. It was all of the other countries in the world. So Canada and Mexico are still subject to the USMCA agreement, which exempts most of our imports from them. I know that that we have a 25% tariff on imports from Canada and Mexico that only applies to goods that do not fall under the USMCA agreement, which are goods that are produced and the components primarily come from North America. So there's a lot that's exempt from those tariffs. And I know that's a question that some people have asked me personally. But you can see we also have a lot of countries subject to that baseline 10% tariff. Remember, they're still paused, but if they don't get a trade deal pushed through, this is how it'll look. China will have a 145% tariff, and there are several countries that are somewhere in the middle here. So what we can expect if we see successful negotiations between the U.S. and these other countries, we'll probably still have some mild tariffs, but that's okay. A lot of those milder tariffs can be absorbed in the supply chain, and we expect inflation to start decreasing this year in 2025. By some measurements, inflation has already started decreasing. By others, it hasn't. It's a little bit of a conflicting story there. But we can expect if actually mild tariffs be implemented, inflation will continue a downward trend. The economy should do well. There will be a little bit of revenue generated from the tariffs, but overall it won't have a major effect on the economy, even in the short run. Now, if we don't have successful trade negotiations, we're looking at high tariffs. That might last a while. Tariffs cause a one-time inflation spike. So when the tariff goes into effect, prices jump up one time. And then so we think in 2026, there would be, well, in 2025, there would be that inflation spike. In 2026, we would see the inflation start a downward trend once again. And of course, if the tariffs end up high, if they're extremely high, we could have a recession caused by them. So that would be if trade tensions continue to escalate. Right now, we're more on the side of seeing some successful negotiations, and I'll talk to you about that in a little bit. So right now, just yesterday, we found out that the U.S. GDP contracted 0.3%, so it was down 0.3% in the first quarter. That headline sounds not great. The traditional definition of a recession is 2 quarters of GDP contraction, and we just had one. But we need to dig into that report because the contraction was actually due to a surge in imports by 41%. If we didn't have that surge in imports, if we actually took imports out of the GDP calculation completely, GDP would have been up 3% in the first quarter, and it would have been up 2.99% in the fourth quarter of 2024. So you can see that surge in imports to get ahead of the tariffs really drug down the GDP, and it made it a little misleading this quarter. Overall, all of the other GDP numbers looked pretty good going into the calculation. Consumer spending actually increased by 1.8%, and excluding, well, I already went over that. Excluding imports, GDP was up 3% in the first quarter. Inflation by the Fed's preferred inflation index ran a little hotter than expected. Employment's starting to cool off. Businesses are sort of holding off on investments till they understand what's going on with tariffs and where to invest their money. The S&P, which is what we use for a lot of our research, S&P Capital IQ, they expect the U.S. to grow at 2.2% this year, and they revised that down from 2.5%. So they're still expecting the U.S. economy to grow through the end of the year. If we did have a recession, they're expecting it to be a short 2-quarter recession, but I don't think that they're even expecting that. Some economists are less optimistic, and they peg U.S. growth at 0 to 1%. And it really just depends on how the tariffs end up being implemented. But GDP growth is expected to grow in all countries, or slow in all economies around the world. So it's not just the U.S. We're not alone on this. Inflation, like I said, if tariffs are implemented at a high rate, inflation is going to increase this year. As of March, inflation was 2.4% over the last year. There was a 0.1% downward change in inflation or in prices in March. So if the tariffs don't end up being, like I said, if the tariffs don't end up being severe, we will see prices continue to decrease. Right now, 1/4 of a basis point, 0.25% rate cut is projected this year from the Fed. Some people think there might be 3 rate cuts. We will see. We haven't had a lot of guidance from the Fed yet on how they plan to cut the rates, although we can expect them to do so this year. So what would cause us to see some relief for the markets, some upswings in the markets that will pull us out of the downturn that we've had? And a big one's going to be successful trade negotiations. Obviously, relief from the 145% tariff on China would be huge for a trade negotiation. So that would have a great impact on the market. We've seen some softer rhetoric between the countries, some rumors that one or the other has approached each other to talk. But in general, there's not been a whole lot of movement. I will say that China has exempted a group of U.S. goods from their tariffs. And so they're still importing some U.S. goods. And they've had recently a significant decrease in their factory production because of our tariffs. And so that will incentivize them to come to the table with us. The UK has a proposal on the table to reduce or eliminate all non-tariff barriers on the U.S. agricultural products in exchange for a reduction in the auto tariff. We'll see what happens with that. And India is probably the most promising country for a trade deal in the near future. India, there's been a lot of progress with them. We've heard really positive rhetoric from the Treasury Secretary talking about how we're pretty close to a deal there. And India wants to make us one of their forward most favored nations, which is just a recent development here. And that basically means that whatever trade deal that they make with us, if they make a trade deal that's better with any other country, we would automatically be subject to that better trade deal. So they basically want to place us at the top of their, as basically their closest trade partner. And so once we see that happen, I think that there's going to be a lot of positive movement in the market. India can take a lot of production pressure off of what will be lacking from China. So that would be a great opportunity. Some other countries to watch that would be huge for the markets and really helpful. Japan, Vietnam, and South Korea. We've had really good trade talks with them. Mexico and the European Union are also important. Although keep in mind, Mexico is still not subject to the additional tariffs at this time. So unfortunately, we don't have an actual trade deal done yet, but maybe in the next few days we'll see something happen there. We also have the potential for more delays on the tariffs or exempting more products from tariffs. I know that as of last week, when I put this together, there were auto parts that were exempt from the tariffs. But I think that we're looking on autos at this point, possibly a wider exemption. And so that would be really good for the auto industry. And consumer technology is also exempt from a lot of the tariffs too. Another avenue that will provide relief from markets, and I think relief from tariffs in general, it will make the U.S. more likely to come to an agreement with countries that may not have given us as much as we want on our tariff concessions, is new corporate investment in American manufacturing, and we've already seen a lot of that. So since the tariffs started, we've had Johnson & Johnson commit $55 billion to manufacturing in the United States, Taiwan Semiconductor, NVIDIA, Apple, Eli Lilly, Novartis, which is Novartis is a healthcare company, a huge one like Eli Lilly. Hyundai, Merck, Siemens, GE Aerospace. These are all really good paying manufacturing jobs in sectors like technology, pharmaceuticals, and defense, and autos. So these would create great opportunities long term for the American economy and insulate us more from potential conflict. If we're relying on China, for example, for pretty much all of our goods, and they don't want to send them to us anymore, then we will have a shortage. So it's good for us to have some of this manufacturing here in the United States, particularly in these industries. So how do we know all of this uncertainty is going to be short term? First, we have the political pressure of midterms coming up. In 2026, we're going to have midterm elections. And if the economy is too far off the mark, the president's not going to be able to get his own party reelected, and he'll lose a lot of power. Presidents don't typically like that. And so he'll probably concede on some of these tariffs sooner rather than later. Progress on the business investment that we've seen alone may be enough to create a walk back on some of these tariffs, even, like I said, if we see just nominal concessions from other nations. And then also, we've got the Tax Cuts and Jobs Act almost certainly being extended this year, since Republicans control Congress and that was their bill. That was a big tax cut for the American economy. Hopefully there's some additional tax cuts in there as well that will help in the face of some mild tariffs. We also have the increased business investment we discussed. Lower energy prices. Energy prices have come down quite a bit. That's going to relieve pressure on the supply chain and make it easier for the supply chain to absorb tariffs. We have the Fed rate cuts that we expect this year. So all of these things will help offset the effect of tariffs and the inflation caused by them. We've also, throughout the year, heard some other market risks thrown around, so I just wanted to address them real quick. Stagflation. You haven't heard anything but tariffs recently, but people were talking about stagflation before. I think that's very unlikely in the current economic environment. Inflation really does seem to be cooling overall. And I think the Fed will lower rates, even if we see a short-term spike in inflation, because they will understand that tariffs are one-time inflation spike. Or they should understand that. I know some of the Fed understands that. So I think we'll get rate cuts if we have a cooling in the economy. And I don't think that we're really at risk for stagflation at this point. We also have wars in Eastern Europe and in the Middle East. Right now, the trade concerns overshadow those. Last night, we just got a deal with Ukraine for their mineral rights. Trump dropped his demand to have a payment back for the aid that we've already given them. So they don't have to pay us back for the aid we've given them, but now we have an interest in our mineral rights. So maybe we see more progress on the conflict ending between Russia and Ukraine now that that's done. We would, in a situation where a war in the Middle East or in Eastern Europe were to escalate, we would just rotate more to defensive sectors. This would most likely spur domestic production. Typically, when there's a world war, the market has a big pullback at the beginning, and then you get a surge in domestic production. Domestic companies do very well, and the market actually ends up doing all right, although we hope that doesn't happen. Hopefully, that's not something we have to worry about. So what are we doing today? We're focusing on fundamentals. We're looking for quality dividend paying companies, even in the long term, even in the growth style portfolios. We're tilting more toward those quality dividend payers. Growth companies that have strong growth opportunities can be high quality too, but they tend to have more debt and there's just less certainty, and so they're more exposed to downside. They tend to have things like higher valuations, which also expose them more to downside. So we're focusing more on quality and certainty right now. We want to look at the long-term growth expectations for companies. I think the impact of the tariffs are going to be relatively short-term. And we want to position you all in companies that are going to help you in the long term. And we'll look more toward international opportunities too, but probably not in current equity income. That's a domestic portfolio. We keep our clients always exposed to all sectors. So that is all parts of the market: healthcare, technology, utilities, consumer discretionary, consumer staples. You're exposed to everything. But we'll overweight positions in more defensive sectors like staples, utilities, healthcare during times of uncertainty. What we don't want to do is underweight tech too much. Technology, semiconductors, AI, that's where a lot of potential market growth is coming from. And when we get these big upswings in the market, it's tech that's driving the market. So we don't actually want to be underweight in the part of the economy that's going to spur growth for you. Fixed income. We want to stay short term with our fixed income right now. Even though the Fed's going to be lowering rates, what we saw in the fall was when Fed lowered rates, rates went up anyway on long-term fixed income, which drove down bond prices. And so it's still smart right now to stay short term. Over allocating in bonds actually hinders your long-term performance. And there's a lot of risk present in the bond market that can detrimentally affect bonds for a longer period of time in the way that we just don't see in the equity market. One of them being the credit quality of the U.S. with how much debt we have and how much an interest expense that we have. Any issues that come to fruition with that can cause a long-term pullback in bonds. So we don't want to over allocate in fixed income, particularly long-term fixed income. We stay short-term for you guys. Gold has been outpacing all other safe havens this year. I think at this point, it's vulnerable to downside as the market recovers. So if you own gold already, I think that's great, but it may be too late to add it to your portfolio. Now I'd like to talk to you a little bit in general about market pullbacks and corrections. Everybody hears, pullbacks are a normal and healthy part of the market cycle. But when it's actually happening, it's hard to feel that way. It's hard to feel like stocks are on sale when the world feels like it's on fire. But a pullback of 10% occurs every year and a half, just about. A 15% pullback occurs every 2.5 years. A 20% pullback in the market occurs every 4 years. And every 9 years, we see a 30% drawdown on the market. And so this is a pretty typical part of the market cycle. And it pays to stay invested through these. If you were invested in the S&P over the last 20 years, and you stayed fully invested, you would have an average return of 10.4%. But if you just missed the 10 best days in the market, you would only have an average return of 6%. If you missed the 20 best days, 3.5%. If you missed the best month of days, 30 best days, 1.3%. If you missed the 60 best days, you would actually have a loss 3.7% per year on average. Being invested. And so that's why we always tell people you can't time the market. And in fact, 7 of the 10 best days in the stock market over the last 20 years have occurred within 2 weeks of the 10 worst days. And we really saw some of that play out even this year. There were some days with huge gains in the market, even after we had that week of a drawdown after Liberation Day. So stay the course, stay invested. People ask me a lot, what should I be doing in my portfolio right now? Just talk to us. Make sure we understand your risk investment objectives and your risk tolerance, because we are doing everything that you need in your portfolio to adapt to the conditions and not hurt you in the long term. So I want to thank everyone for their time. If you have any questions, I'm going to give everyone a couple of minutes to submit questions. If you've got one you'd like to ask, and otherwise, I really appreciate your time. I'm going, like I said, this is recorded. I'm going to send out a recording to everyone, and please provide feedback so I can make this better for everyone in the future too.